Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Phil Orlando, the Chief Equity Market Strategist of Federated Global Investment, writing the following. We expect the Fed to cut interest rates by a quarter point at both its September and December meetings this year, which should boost stocks towards our 7,500 target next year for the S&P 500. Phil joins us now for more. Phil, good morning.
John, thank you very much for having me back.
Thank you for being here, sir. Let's talk about the month ahead. Payrolls this week, inflation next week, and then the big Federal Reserve meeting. How are things shaping up for you and the team?
So we've had this massive 35% rally off the Liberation Day bottom going into, I guess, the week before Jackson Hole. And then the market traded off about 4% or so because the market didn't really understand or appreciate what sort of a tone would Powell take at the meeting. Now, the rally we've seen over the course of the last week or so has been that Powell took the right tone, that the Fed is thinking about easing. But as we get back to, the day after Labor Day, everyone's back from vacation. Now, the cold dose of reality sets in. All right, what's the next set of inflation data going to look like? What is the labor market data this week? And then you've got all the noise surrounding the Fed and tariffs. And does Miran, does he get seated this week? So at this point, that dose of reality, we think, given the fact that we've turned the calendar to September, there could be some chop here looking out going into the September 17th meeting.
Well, let's touch on a potential source of tension, let's say. The move we saw in the last month to see cyclicals outperform, to see the airlines up double digits, the home builders up double digits, to see the Russell of small caps up by 7%, at a time where the chairman is increasingly worried about a cyclical downturn. Does that one stack up for you?
So we love small caps, just full disclosure here. And the key reason for that is we believe lower interest rates. Not only do we think we've got 2 quarter-point cuts this year, we think we've got another 4 quarter-point cuts over the course of next year. The funds rate by the end of calendar 26, we think the upper band is going to be at 3%. If we're right, that suggests that you've got an excellent backdrop for small cap stocks as well as those consumer cyclical areas. So that's our longer term view. But there's a lot of noise and nonsense that we're going to have to parse through over the course of the next several weeks.
Given the fact that this would be the deepest rate-cutting cycle outside of a recession ever in data going back to the 1980s. I mean, this is something that a lot of people have pointed to. So do you see these cuts coming irrespective of whatever economic data that we get? In other words, you can question the politics of the moment, but what this market seems to be pricing in is rate cuts for the sake of rate cuts that juice growth and possibly inflation, regardless of the economic data.
Great point, Lisa. We're looking at that dual mandate. We're looking at the data. And so while there is some concern about inflation, we're focused on the labor market here. What's happened in the labor market over the last three months? The average non-farm payrolls, 35,000. The first 4 months of this year, that number was up around 125,000. All of last year, that number was 168,000. So the labor market is materially slowing. This coming Friday, we're going to get the August non-farm payroll report. The August report, historically, is the wonkiest report of the year. There's going to be a lot of noise. You've got summer vacations in and out. Companies, manufacturing facilities take downtime in terms of furloughing temporarily workers and whatever. And then next week, I think it's next Tuesday, we're going to get the annual payroll revisions. Last year, that revision was down 800,000 jobs. We think the revision this year could be down another 500,000 or 600,000. So we'd be focused more on the labor market and the deterioration there as opposed to what's going on with inflation.
If inflation is higher, though, and you do see that sort of crimping in the labor market, the sort of loosening or in the labor, I should say, this issue of people not being able to get jobs, then why would small caps rally, which are typically hinged to growth, when that's a stagflationary backdrop?
So we think that growth ultimately over the course of next year is going to improve. Let me throw this data point out. Our macro policy committee at Federated, our GDP forecast for next year is 2.8%. The blue chip consensus is 1.4%. Within the blue chip consensus. The highest estimate on the street is 2%. So why are we at 2.8? One of the things we're focused on is the fact that we are looking for a significant improvement in economic activity coming in corporate capex. One of the key provisions in the One Big Beautiful Bill was 100% expensing. So you look at productivity growth in the first quarter of this year, and it was negative by 2%. It's never negative. What we think was happening is a lot of companies were holding back their capex plans, saying, we're going to wait to see what's in this piece of legislation.
Okay, but that was also contingent on some clarity around tariffs. Don't some of those plans get withdrawn now that there's a real question mark around how much the tariffs go into place?
Well, the tariff question is an open question at this point. And so I think legislatively we've got that, but I think this is ultimately going to be decided by the courts, particularly the Supreme Court, in terms of the legality of the tariffs.
Despite that, you're clearly looking for a re-acceleration in growth through the next year.
Absolutely.
And arguably the market's picking up on that in the last month. Do you think what's happening at the long end of the yield curve is a reflection of a better growth profile in our future? Or do you think it could become a constraint for risk assets?
So the way we're looking at the yield curve is you're probably going to see a further steepening, lower interest rates at the low end, higher interest rates at the high end. But as we look out over the course of the next 18 months or so, we think the benchmark 10-year Treasury yield could be working down towards the 4% level, which is supportive, we think, of consumer cyclicals and smaller cap stock.
Stay with us. More Bloomberg surveillance coming up after this. Let's extend some of this with Leland Miller, the CEO of China Beige Book. Leland joins us now for more. Leland, welcome to the program. Is China and President Xi, from an economic standpoint, operating from a position of strength?
I wouldn't call it a position of strength, but it's getting stronger considering that a lot of countries are backing away from their close relationships with the United States. I mean, if you look what's happening with India right now, India doesn't want to be looking around the room and see China on the left and Pakistan on the right and Belarus across the room. I mean, it would rather be in a group of countries, the United States and others, and strengthening trade relations there. But it will push back if it thinks it's being pushed into a corner. And so we're seeing a situation where China is becoming an attractive option because it's not the United States right now.
It seems like Russia and China have a very clear relationship. China is almost the owner, or Russia is the vassal state of China because it is so dependent on its revenues. The relationship between India and China is much more complicated. How do you see that evolving? How close can they get, given how incredibly contentious the relationship has been for decades?
Yeah, look, India considers itself a non-aligned country, and a lot of countries do in Southeast Asia too. That have said they're not going to be a U.S. ally directly or a Chinese ally. They're going to manage relations with both. I mean, you've got Indonesia, you've got Vietnam, you've got a lot of other countries. But within that non-alignment label, there have been tightening relationships for years and years in the United States. It's been geopolitical, it's been economic, it's been trade. These things have been very advantageous to U.S. policy goals, trade and foreign policy and even military in the Pacific region. And if all of our policy ends up backtracking to become one big question about sort of fair trade, but it doesn't have any look at the geopolitical side instead, and how are these things balancing out, then we're going to wake up 5 years from now. We're going to realize that we've just undid 20 years of diplomacy that have sort of pushed back against the China-led world. It's a problem.
How much are you already seeing some of these new alliances in the trade data? I mean, we've seen, for example, Chinese exports that have decreased substantially to the United States, but that have increased substantially to the rest of the world. Do you see that along alliances, or is this just transshipments? The idea of finding the weakest node that they can get products in that can eventually get to the United States?
Yeah, it's not alliances, but it's not all transshipment either. It's essentially China shoving its exports down other countries' throats. And, the United States has, you can see it in our China Beige Book data. You can see it in other trade data. The direct shipments from China to the United States have been going down, but China has been just unloading its exports, in particular, into Southeast Asia because they can't push back. They can't push back geopolitically. They can't compete with Chinese lower prices that are sort of dumping their overcapacity into Southeast Asia. Asia. So it's not about tightening economic block. If anything, it's the opposite. But it means that in a world in which China is trying to find places to dump its exports, it's picking on its weaker neighbors, and it's being very successful right now.
Leland, can we just stand that point? China's overcapacity. We had a guest on the program about 40 minutes ago making the argument that China was going to address that. Do you see any sign of that whatsoever?
It's one of these things that people read they read what the government's plans are, and they say, oh well, the government must be willing to address this. They're they're going to spur have more consumption. They're going to have more stimulus. They're going to have they're going to combat overcapacity. Finally, the model doesn't allow them for them to do this very easily. So look, if it was a priority in the short term, yes, I think that they're doing little things. This anti-involution campaign, they're trying to weed out some of this price competition that comes from every provincial government in China subsidizing the same stuff, leading to oversupply, leading to exported oversupply and this overcapacity problem. So yes, in the short term they're going to deal with it on a micro level, but the economic model that China has, which is stimulus to the supply side and not to the demand side, it does not allow for them to shift things away. They're going to have more overcapacity, and they're just going to have to find places to bury it until some bloc forces them to do otherwise.
Leland, just why are they married to that particular model? What would it take to make them change their mind?
Well, I think it's what Xi Jinping and Chinese communist leaders have thought for a long time. What they want to do is they want to produce more. They want to build up their industrial base, and that's fine, and that's laudable from their perspective. But what has happened is it's all the stimulus. The entire model is based on spurring more production and more exports, and they're being very explicit about that in the last couple of years in particular. So as long as you're trying to produce more, but you have very weak domestic demand, and you're doing absolutely nothing structurally in order to empower consumers or households or the private sector to become more consumers back home, what you're doing is you're having a model that's completely reliant on production. And that's what the model is right now. It's why China is very vulnerable, but also not a very good trade partner for others who want them to import more.
Stay with us. More Bloomberg surveillance coming up after this. Ken Hoexter, the Bank of America Securities Senior Analyst of Air Freight and Surface Transportation, joins us now for more. Ken, good morning.
Good morning, John.
Let's extend some of that conversation, and thanks for being here. Let's take the de minimis exemption. Can you just walk us through, give us a feel for how much of the overall volume between, say, trade between the US and China that actually accounted for through air freight alone?
Yeah, and happy post-Labor Day. Welcome back to work, everybody. So, it's a great question in terms of, Brendan was mentioning the 1.5 billion packages a year. It's about 4 million a day. So you've got a lot of frequency. UPS and FedEx export combined about 2.8 million packages per day. So they're representing, and that's not all de minimis, but a huge portion of this de minimis movement on a per day. But international is only about 25% of each of UPS and FedEx's revenues. And then the export portion is only 17%. So we're still talking a small portion, as Brendan mentioned, a smaller portion of the number of volumes, or the high volume but low value of the packages moved. But this is meaningful. This is the highest profitable lane, is the US-China lane. So we've already seen those volumes down about 75% year over year once this went into effect in May. The new news here is on Friday, it expanded to the rest of the world. So that's about 24% of de minimis is now encapsulated in this new expanded part.
How enforceable is this?
So it's enforced by the U.S., right? So it's something that our Customs and Border Protection Division is going to be watching. And so now everybody has to comply. The difference of what's going on before is UPS and FedEx already required the information on what's in the package, but now you've got to get who made the packet, who made the goods. And so the difference is the postal operators. He was mentioning 30 different postal service operators suspended because they don't have the technology. Before, you could just check a box that this was a small, low-value package. Now you've got to give so much more information. So that's guarded by the CBP on imports.
No, I was just wondering, if you get on a plane, let's say, and you get $500 worth of goods from some country, how do they come on the plane and get it? I just wonder, is this, I'm just thinking theoretically, stop laughing at me. I mean, how do they enforce this? Does it become difficult given all of the changes in the tariff regimes and some of the legal challenges?
Yeah, what you're carrying on you, that's still not going to change as far as that $800 limit, right?
I think Lisa's just looking to clarify for personal reasons.
This is mailing cross-border, right? So this is what's going in packages, what's going on vessels, what's going on different methods of transport, even rail cross-border. So they're managing what packages are going cross-border.
Of the companies that you follow at the moment, who's executing really well? Who have you been impressed by?
Well, I mean, they're executing in terms of FedEx and UPS already move traffic, right, have the skill sets. But this is a question about what's going to happen with the increased rates to those packages. So, for example, Temu and Shein, right, these were low-value shippers that had found a loophole and expanded that loophole. We went from 100 million packages 20 years ago to 1.5 billion, right? And that's already up to 900 million packages at run rate by the time this went into effect in May. So you're seeing this is really taking those companies that learned how to take advantage. And what you've seen is Shein's volumes are down 23%. I'm sorry, down 12%, but revenues are up 23% because they've taken rates up to adjust for the tariffs, or they've gone in and as you were mentioning, gone to different countries.
Stay with us. More Bloomberg surveillance coming up after this. Erin McLaughlin, the senior economist of the Conference Board, joins us now for more. Erin, welcome to the programme. Let's talk about your data, the loss of confidence. Are you seeing that more pronounced, or have we seen a bounce back as we come into the post-Labor Day period?
We have not seen a bounce back yet. It is still, after our sort of dip after Liberation Day, it elevated a little bit in May, and it's still very similar, those numbers. Looking at sort of a trend or a possible emerging trend, it looks like younger consumers under 35, are feeling more negative than some older consumers. And we think in part this might be, well, in general because of cost of living, but one thing that we're also closely looking at is the end of de minimis and the additional cost for fast fashion and other items.
Hold on a second, Erin. Are you saying that because people can't get their Shein packages and that's typically the younger individual, they're feeling worse? Is that what you're sensing?
I am sensing that could be the case, yes. So we've done some analysis. These packages that have come directly from China, other places from around the world that have really boomed the last few years. And in fact, 83% of e-commerce packages come de minimis, and they came in virtually without any tariffs on them because they came direct from China and elsewhere. And we think that the additional tariffs could add up to 0.2 of a percentage point on inflation over the next year. And, it could be a downer for younger consumers.
Taking a step back, there are two prongs to the consumer confidence side of things. On one hand, there's this question about inflation, which has been a really dominant theme over the past number of years. On the other hand, it's employment, and that's kind of what we're looking for to understand what the breaking point will be. Are they still confident that they will have jobs? Are they still confident enough to keep spending, even if they don't feel very good about it? Because they haven't always done what they've said they've felt when it comes to inflation.
Right. Right now, it seems that consumers still feel that the labor market is fairly healthy, although they're starting to reveal in some of the answering of some of our data that they sense that there's less jobs available out there, which is kind of interesting. So personally, they may feel confident, still continue to spend, but we do think this spending will be on sort of not on discretionary goods is where it will weaken, that non-discretionary goods is where consumers will continue to focus. And that when it comes to big purchases like appliances and automobiles, as tariffs increasingly have an impact on these, we just may see that confidence erode in the future months.
Erin, let's talk about confidence, particularly about the labour market. I think there's a lot of confusion right now about whether the step down in payrolls for growth is leading towards an increase in labour market slack or not. What do the attitudes of consumers towards the labour market sound like now relative to where they were only 6 months ago?
Well, I think consumers recognize that the labor market is loosening, but consumers often act based on their own situation. So if they feel confident in their own situation, they will continue to spend generally. They may be a little bit more wary, but if they see, even though the unemployment rate has remained steady, if they sense that there's less jobs out there, i.e. if they lose their job, it will be harder to get a new one. That will certainly has a potential to impact their confidence.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.